Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the most bullish scenario on the weekly time frame, which is a double 1-2, a 1-2 in yellow, 1-2 in green, and look for big continuation towards the upside in a wave 3. Now, what are the probabilities for this scenario? I'm going to cover two things, the rule of alternation and the wave 4 guideline. Now, starting with the rule of alternation in Elliott waves, which says that if you have an impulse in a wave 1, 2, 3, 4, 5, if wave 2 is a very shallow corrective structure, you would expect wave 4 to be a sharp corrective structure and vice versa. If wave 2 is sharp, you expect wave 4 to be a sideways corrective structure. Now you can see that the yellow 1-2 here is definitely a sideways and shallow corrective structure for a wave 2. It only retraced to the 0.382 Fibonacci taken from the low to the high of wave 1, and that is only if you put this 382 not on the logarithmic scale. So if you check this box here, because my chart is on log, if you check the box and make the fib log as well, then you can see we didn't even hit the 0.382. So it's a very shallow retracement for a wave 2. Therefore, if we're looking for an impulse, 1, 2, 3, 4, 5, based on the rule of alternation, you would expect this range over here, this retracement, to be sharp, to be quick, to be scary. But at the moment, you can see that this structure so far is actually very sideways as well. It's not scary, it's not short, it's not that deep. And also, we only retraced again to the 0.382 taken from the low to the high of wave 1. And once again, we've only touched the 0.382 because I didn't put it on log. The moment I put it on log, we haven't even reached the 382, and for a wave 4, the 382 is at least a common target, but so far this is quite the ranging structure and not the deep structure that you would like to see actually in the rule of alternation. 1, 2 sideways, 3, 4 deep and scary and short, and continue up in a wave 5, right? Now, the second thing I wanted to talk about is the wave 4 guideline. If we look at an impulse to the upside, 1, 2, 3, 4, and then a wave 5 to the upside, then your wave 4 of a higher degree likes to retrace to the wave 4 of a lower degree, which is the wave 4 inside your wave 3. So then we have a 1, 2, 3, 4, 5, right? Now, most commonly even, your wave 4 of a higher degree tends to end around the termination point of the wave 4 of a lower degree, which in this case would be around the lows. But as a bare minimum, you would like to see a wave 4 of a higher degree move towards the range. It is a guideline, it's not a rule, it's not a must, but it is a guideline nonetheless, right? So it's good to know about. Now that would mean that preferably, if we are looking for an impulse to the upside 1, 2, 3, 4, 5 instead of a double 1-2, which is a lot more bullish, we would also actually like to see price retrace a little bit more towards the downside to at least 49.1k to touch the lower degree wave 4, which at the moment we haven't done. We made a low at 53.2k, which arguably is still quite far away from the wave 4 of a lower degree. Makes one think, right? Now, the other bullish scenarios, right, also lead to price moving to the upside. Here we have the impulse 1, 2, 3, 4, 5 in yellow, and then the yellow wave 3 is what we're working on right now with a 1, 2, 3, 4, 5, right? Common target for 4 is the 05, 618 is your invalidation, 49.3k, and you want to see a wave 5 to the upside, another retracement in 4 and another 5. The reason that the wave 4 in yellow has this box as a target area is because of the guideline for a wave 4, right? Your yellow wave 4 is the wave 4 of a higher degree, the green wave 4 is the wave 4 of a lower degree, and the higher degree tends to retrace to the wave 4 of a lower degree, which is the price section over here, which then becomes a potential target area for the yellow wave 4, after which we look for a 5 towards the upside, right? So the double 1-2 is the most bullish scenario. This is your medium. And then we have the arguably most bearish bullish scenario, which is where we have a wave 1, 2, 3 is already finished, sideways 4, and a wave of 5. Now, of course, I say sideways 4, but preferably we see a deep wave of 4 here, right? Preferably here, you see a wave 1, sideways 2, 3, deep 4, scary, and then move towards the upside. Target area for your 4 is on the chart, 236.05, taken from the low to the high of 3, 57.1, 42.8, 0.618, your invalidation at 37.7k, and preferably still your wave 4 would end somewhere around the 1-to-1 or after the 1-to-1, which is the 12th of August, which is a fib time taken from the start to the end of your wave 2, and most commonly wave 4s are a bit longer, but if they are scary and short and deep, they definitely can be shorter as well. But at the moment, we don't really see that yet. But the reason this is your most bearish bullish scenario is you only expect one more push up, and then the bull market is finished and you move towards the upside. So the short difference is that in this scenario here, you look for a bigger wave 3, another 4, another 5, another 4, another 5, right? So you expect 3 more pushes towards the upside. Here you have 2 more to finish wave 3, then we have 4, and then we have 5, and the most bearish bullish scenario is 4 and 5, and that's the end, right? So by all means, the probabilities are higher on the weekly time frame for the bullish scenarios. And after we then take the high, right? If we take the all-time high, we will observe what price is going to give us. And if price is moving towards the upside, all of the information that we need as an Elliott wave analyst is going to appear in the next range, which means that if price eventually moves to the upside to take the highs, we just wait for price to form another bigger sideways range. The moment we get that range, we can analyze the range and get to the probabilities, because also locally on the daily time frame, the probabilities are higher for continuation to the upside. We have hit the 886 that you take from the high to the first low of this range here. You can see the 886 is touched, and this is a rare target for a wave 2, common for a wave B or a wave X. Increasing the probabilities, this move to the downside is corrective in a wave C or a wave Y, and not impulsive in a wave 3 for a bigger bear market to start. If we then zoom into the 1 hour time frame, then price has moved very nicely today. Some volatility, very good. So we had a leading diagonal here on the chart, 1, 2, 3, 4, 5 wave structure, 1 or A. Look for a corrective structure to the downside inside the box, which we have got, right? So we moved into the box. Doesn't mean price has to go lower. We do have some interesting additional support to the downside if it wants to go lower. The blue box here, 56.2, 55.7k, but as you can see, we hit the 382, just missed out on hitting the 0.5 at 56.5k, 382, 57.2. Common target area for 2 is the 05786, 56.5 to 54.7k. Now your bearish scenario is a 3-wave structure in an A, B, C, and then we want to see an impulse to the downside. So a wave 1, 2, and eventually a wave 3 to the downside, looking for a new low. So in other words, what's going to impact the probabilities locally is that in a wave B or 2, we want to see corrective structures to the downside, right? 3-wave move. No problem to move to the downside. It is even the common target, but we want to see corrective structures, not impulsive structures. While in the bearish scenario, we are looking for impulsive structures to the downside. Wave 1, wave 2, either finished or during the weekend, more sideways price action for 2, and then a 3 towards the downside. High volume, lose support, looking for new lows, and we do still have some interesting support to the downside as covered in previous content. Now the price action locally has pretty much played out to the T, which is incredible. So price was ranging here in the morning, and what we said in the morning is the probabilities are higher to look for a bounce to the upside, because so far price moved towards the downside without touching the 0.382, right? So if we would move this back and I take the fib to this low here, then you can see that price here didn't touch the 0.382. It continued to the downside, and then once again price started ranging. We haven't yet touched the 382 after the low was made. Now the 382 for most scenarios is a minimum target for wave A, B, C, W, X, Y, 1, 2, 3, doesn't really matter. So we were looking for price to move towards the upside. We did have some bearish CVDs, but as explained during the live stream, these bearish CVDs here weren't that powerful. We didn't really get a big move to the downside. Swing failure pattern this low here started to build bullish CVD divergences, and the moment we broke out towards the upside and hit the daily naked point of control, which was here, a little bit of a reaction, but as shown during the live stream, still bullish CVD divergences, increasing the probabilities to look towards the upside even further. And after the point of control, the daily naked point of control, this was our area of interest, golden pocket, 15-minute order block, and also the value area high of the range that we are in for a absolutely beautiful rejection. Now, if we zoom out again to the 1 hour time frame, look at the CVD divergences, then you can see we do have bullish CVD on the 1 hour. So we have a higher low on price, lower low on the CVD, also more locally. But the bigger one is actually the more interesting one in this case, because even if price would continue ranging this weekend or move to the downside, there's still quite a lot of space for this bullish CVD divergence. You have to take out this low to invalidate that CVD. Right now, the most local CVD divergences are the most important one, and after the high here was made, we had a little bearish CVD, some more bearish CVD divergences. These have already played out. So even though also more locally here we have a higher low on price but a lower low on CVD, keep an eye on the very local CVD divergences, the local 3-minute, local 15-minute, so basically this side of the chart here. The CVD divergences appearing over here are currently most interesting, right? But it is good to know that on the 1 hour we do have the bigger bullish CVD divergences, which does add to probabilities of taking out this high at least one more time, which of course then supports the probabilities for a potential ABC or a 1, 2, 3, which of course is the most bullish scenario. And then finally, looking at the probabilities of the different scenarios. On a weekly time frame, the probabilities are by far higher to move towards the all-time high eventually. If price takes the highs, we'll have to wait and see what we get. We have the most bullish double 1-2 as explained. I mentioned the rule of alternation, the guideline of a wave 4, but we have to take it step by step. I personally am not a moon boy. I don't like to talk moon boy stuff, but the double 1-2 is a pretty moon boy scenario. I at least wanted to cover it because it has something to it. But only if we take the all-time high can we judge what is coming next based on the next range, step by step, even with Elliott waves. On the 1 hour time frame, the probabilities at the moment would be higher for price to take out the high. And that's also because of the bigger bullish CVDs that we have on the chart. It's generally quite difficult to really go against the bullish CVDs. Now, it happens when something like this happens. So here, we had bullish CVD divergences here on the 1 hour. These played out. The moment they play out, okay, it's not really that interesting anymore. And then on the move down here, we had consistent bearish CVD divergences, absorption of market longs with limit short orders, increasing probabilities to continue down. So this is something that I'll be looking for here as well. At the moment, the probabilities would be higher for price to take the highs. We have the bullish CVD supporting this as well. Still some additional support to the downside in case price does like to move down lower, right? Perfectly fine. It is weekend. The weekend generally is a ranging structure and not an incredible volatile structure. But I keep an eye on the local CVD divergences, because if we do get price action to the downside, a grind down and more bearish CVD divergences, then it invalidates pretty much the bullish one, because the local CVDs are most important, right? So for now, the weekend comes, generally a ranging structure, not very impulsive, is something to keep in mind. We do have some support lower as well, so we got to wait and see what the weekend gives. I hope you have a great weekend. I also hope you have a great night. Thanks for watching this video. I hope you found it very valuable and helpful. Please check out the brand new complete Elliott Waves Guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.